In this video, we'll talk about how Six Sigma and process improvement techniques can be applied in accounting departments to improve efficiencies like shorter month close, improved skill set, but also increased work-life balance. Many years ago, I worked for a large healthcare company that decided to outsource part of its accounting function overseas. I wasn't particularly excited about the idea, and neither were my colleagues. The consultants involved in the project talked extensively about process improvement and Six Sigma methodologies, but they didn't necessarily understand how accounting processes actually worked in the real world. Definitely not their fault. They appeared to be fairly young and had learned more about the theory of it than they seemed to have practical expertise. Once I began looking at Six Sigma, though, I was intrigued. I completed multiple Six Sigma programs through Villanova University and eventually earned my Advanced Master Black Belt certification. What I discovered completely changed the way I viewed accounting operations. By using time studies, process mapping, and continuous improvement techniques to our accounting processes, we uncovered inefficiencies, duplicate work, unnecessary approvals, training opportunities, and bottlenecks that had existed for years without anyone realizing their true impact. The results were significant. The data showed that if we redesigned our processes and organized the work differently, it would actually cost less to perform the work in the US than to outsource it. The projected savings were nearly $1 million per year, and the organization approved the cancellation of the outsourced work and brought the work back in-house. But the biggest lesson wasn't about outsourcing. The biggest lesson was that accounting departments are full of opportunities for improvement, and most accountants are never taught how to identify them. So in this video, we'll discuss how Six Sigma concepts apply to accounting, how to identify waste in accounting processes, and some practical techniques that any accounting team can use to work smarter, improve processes, and create a more effective organization. A large healthcare corporation that I worked for decided to outsource a significant portion of its accounting work outside the United States. The consultants described outsourcing as a best practice and projected substantial cost savings. Corporate leadership believed the work would be performed by accounting professionals who were just as qualified and efficient as the internal accounting team, only at a lower cost due to wage differences. The consultants initially recommended outsourcing more than 60% of the accounting function. Ultimately, we outsourced about 40% with the expectation that additional work would follow once the model proved successful. And if you've never been part of an outsourcing effort, it's an enormous undertaking. First, every process must be evaluated because not all work is equally suitable for outsourcing. And in our case, the decision was made to outsource primarily low and medium complexity activities. Next, every task had to be documented in extraordinary detail. And these were not high-level procedures or process maps. The work had to be documented step by step so that another individual could perform it without relying on institutional knowledge or prior experience. It became clear fairly quickly after the implementation that the experience level of the offshore team differed from what leadership had expected when the business case was approved, and from the employees we had laid off. Many were recent graduates or had only a year or two of experience. That may work well in some industries. However, healthcare accounting, and especially Medicare and Medicaid accounting, which was my area, is extremely complex. It takes quite some time to develop the judgment necessary to understand the transactions, the regulations, and the financial reporting implications. Learning that remotely while working in completely different time zones made the challenge even greater. To be clear, there's absolutely nothing wrong with hiring recent graduates or less experienced accountants. The issue was not their capability or potential. The issue was that this was not what had been promised. The expectation presented to leadership was that the outsourced team would provide an equivalent level of expertise and experience. Turnover created another challenge. Our internal accounting organization historically experienced perhaps 2, maybe 5% turnover annually. The outsourced organization experienced approximately 20% turnover during the first year alone. As a result, there were constantly new employees joining the team, while many of their supervisors lacked sufficient experience to train them effectively. Much of the work went smoothly, but month-end close leaves very little room for error. During close, managers simply do not have time to review every task in detail, and mistakes can have significant downstream consequences. Another issue was judgment and urgency. The outsourced team generally followed the document procedures exactly as written, but they sometimes struggled to recognize when something looked wrong. For example, imagine a journal entry that historically averaged about $1,000 each month. If the report feeding that entry suddenly produced a value of $1 million, an experienced accountant would immediately stop and investigate. The outsourced staff would often process the entry exactly as instructed because the procedure said to record the amount shown on the report. Similarly, if information needed to complete the close had not been received, there was not always an understanding that the missing information represented a critical issue requiring escalation. During a compressed close cycle, delays of even a few hours can create significant problems. Communication differences created additional challenges as well. Of course, communication styles vary among individuals everywhere. However, our U.S. teams learned quickly that a verbal yes or a nod during a meeting did not necessarily mean that the request was understood or that follow-up would occur automatically. We became much more explicit in our communication. After meetings, we often held separate follow-up discussions asking questions such as, did you understand what was discussed? Do you understand how this impacts your responsibilities? Do you know what actions are required? Will you be able to complete the work? Will it be completed by the deadline? Finally, whenever issues were raised, one of the first responses from the offshore organization was often, what are your metrics for this process? Or are those expectations documented? As a result, we found ourselves creating scorecards, documenting metrics, and holding significantly more meetings than had ever been necessary with the internal accounting teams. In short, outsourcing did reduce labor costs, but it also required an entirely new layer of infrastructure to manage, monitor, train, and support the outsourced organization. Initially, leadership viewed many of these concerns as normal implementation problems. There was a belief that the department vice presidents and accounting leaders were simply resistant to change or frustrated about losing experienced staff. And to be fair, every large implementation has challenges during the first few months. That's completely normal. New teams need time to learn processes, relationships don't develop in a split second, and performance usually improves with experience. However, as the issues continued, and especially when some of those issues began affecting the month-end close process and financial reporting timelines, it became increasingly clear that these were not temporary startup problems. There were fundamental process issues that needed to be addressed. At that point, the conversation shifted from when will the outsourced team get up to speed to what do we need to do to fix this, and are we actually saving money? The original business case assumed that accounting work could simply be transferred from one group of accountants to another group of accountants at a lower labor rate. But that wasn't what happened in practice. The outsourced team primarily handled low complexity and some medium complexity activities. We simply couldn't move the more complicated work because the quality and consistency of the existing work had not yet reached the level required to transition additional, more complex responsibilities. As a result, the outsourced team was heavily utilized during the first 2.5 weeks of the month, while transactions were being processed and routine close activities were being completed. However, after the close and after the balance sheet reconciliations were complete, the nature of the work changed. Historically, our internal accounting teams would shift their attention toward projects, system implementations, process improvements, acquisitions, and other strategic initiatives. Unfortunately, much of that work could not be transferred to the offshore team. Part of the challenge was experience and business judgment. Part of it was that we did not yet have enough trust in the quality of the output. And part of it was simply logistics. Participating in project meetings becomes much more difficult when the team is operating in a completely different time zone. As a result, there were periods where portions of the offshore team had relatively little work available, while the remaining U.S. staff were working weekends and evenings and trying to keep up with the activities that could not be outsourced. That imbalance created understandable frustration. The remaining U.S. employees felt that they were doing the most difficult work under the greatest time pressure, while simultaneously spending additional time training, reviewing, tracking, and managing the outsourced operation. The additional management overhead was significant as well. There were more meetings, more status reports, more escalation calls, more metrics, and more tracking than had ever existed under the previous model. And to be fair, maybe we should have had some of those in place before. Eventually, the question became less about hourly labor rates and more about total cost. This was around the time I started taking Six Sigma classes. Ironically, the consultants who had originally helped implement outsourcing talked constantly about Six Sigma principles. So I decided I wanted to understand the methodology myself. I volunteered to take the training, and I was fortunate to have a very supportive VP who approved the investment. The classes were not inexpensive. By the time I completed the training through the advanced master black belt level, the company had invested well over $20,000 in my education. Looking back, it was probably one of the best investments the company and I made in my education. About 2.5 years into the outsourcing relationship, attention started shifting toward the contract renewal decision. Instead of debating opinions, I wanted data, and I was curious about how Six Sigma could help us and answer the question of whether outsourcing was creating value. One of the fundamental principles of Six Sigma is the DMAIC framework: define, measure, analyze, improve, and control. The first step is to clearly define the problem. The second step is to measure the current state of the process. Not estimate it, not assume it, measure it. And once we defined our problem, the question of whether outsourcing was truly delivering the value we expected, the next logical step was obvious. We needed data, not opinions. As Edward Deming, one of the founding fathers of quality management and Six Sigma, famously said, "Without data, you're just another person with an opinion." We needed data as well so that we could understand how accounting teams were actually spending their time. And one of the Six Sigma tools for measuring that is a time study. Asking only the offshore team would have immediately created resistance and accusations that the exercise had a predetermined outcome. On the other hand, my colleagues who were also accounting VPs in other regions were not thrilled about asking their teams to participate either. There was already tension between regions, the old East Coast versus West Coast issue, that introducing mandatory time tracking across the entire organization was unlikely to succeed. So I approach it differently. Working with someone in IT, we built a simple web-based application containing drop-down lists of accounting activities that already existed across all regions. I tested it myself first because the goal was that it would take each person less than 5 minutes per day. And after refining the process, we proposed a small pilot program. About 20 volunteers across an accounting organization of more than 200 people agreed to participate for 2 weeks. And the 2-week time study results were so stunning and convincing that our leadership accounting team agreed to proceed with a 3-month time study. The time study confirmed several things we suspected. The offshore team was heavily utilized during approximately 2.5 weeks of the month and had substantially lower utilization during the remainder. In fact, some employees recorded downtime directly into the time study system. The study also showed that many outsourced activities required more effort by the offshore team than originally estimated when compared to the historical internal performance. But the biggest surprise was that outsourcing wasn't actually the only opportunity. A significant additional opportunity was redesigning accounting itself. Regional teams had evolved independently over time and had become highly siloed. We found duplicate reports, duplicate reconciliations, duplicate journal entries, and inconsistent skill sets and processes everywhere we looked. It was hard not to question why some reconciliations took over 60 hours to complete each month, and why a consolidated report took each region more than 200 hours. There were so many opportunities to shrink the work. I used process mapping, Gartner days to close metrics, and other of Gartner tools, and spun of multiple additional Six Sigma improvement projects. The time study gave us far more than an answer about outsourcing. It provided visibility into how the entire accounting organization operated. Different regions were producing similar reports. Reconciliations for the same accounts were prepared by each region because each region managed different legal entities. Journal entries that could have been centralized were still being prepared regionally. And many activities existed simply because they had always existed. One of the first lessons we learned was that every report has a cost. Whenever someone requested a new report, we started asking a simple question. If your department had to pay an additional charge for this report every month, would you still want it? That question alone eliminated a surprising amount of work. We also consolidated responsibility for enterprise-wide reconciliations and journal entries, improved handoffs between teams, and standardized processes across regions. We carefully analyzed every journal entry and introduced thresholds for approvals and thresholds for posting entries in the first place. We implemented reconciliation quality standards and additional controls to improve consistency and reduce rework. We even developed simple quality metrics for reconciliations that accountants could reference every day by printing them on mouse pads so they were always visible. Individually, none of these changes were revolutionary. Collectively, they transformed how the accounting organization operated. As a result, we reduced the month close process from 7 days to 5 days while improving quality and consistency at the same time. The results exceeded our expectations. The time study confirmed that the outsourced work consumed only a portion of the month and that the effort required to complete that work had been significantly underestimated. More importantly, the process improvements had created capacity throughout the accounting organization. That capacity allowed us to bring the outsourced work back into the U.S. organization without hiring additional staff. That point is important. We did not replace outsourced labor with more internal labor. We replaced inefficient processes with better processes. The accounting team became more efficient, more standardized, and easier to manage. The month-end close became faster, quality improved, overtime was reduced, employee frustration decreased because the workload became more balanced and predictable. And ultimately, the company saved more than $1 million annually. Looking back, outsourcing may actually have been the catalyst that forced us to challenge long-standing assumptions and redesign processes that had needed attention for years. The biggest lesson for me was that Six Sigma is not just for manufacturing environments. Accounting is full of processes, handoffs, waiting time, rework, and inefficiencies. If you can measure those processes, you can improve them. And if you can improve them, the financial impact can be enormous. Looking back, there were a lot of lessons from this experience. The biggest surprise for me was Six Sigma itself. Like many accountants, I originally associated Six Sigma with manufacturing environments and production lines. I certainly did not expect it to become one of the most valuable tools I would use in accounting and finance. What impressed me most was the rigor of the methodology. The DMAIC framework, define, measure, analyze, improve, and control, forces teams to move systematically through a problem rather than jumping directly to solutions or relying on assumptions. That structure dramatically increases the likelihood of success. Many of the decision-making tools I learned through Six Sigma have proven valuable not only professionally but personally as well. Perhaps the biggest lesson was this: data beats opinions. When you measure a process and collect objective evidence, it becomes much more difficult for people to argue with the conclusions. People may disagree with opinions, they rarely disagree with good data. Another lesson is that accounting inefficiencies are often hidden. Unlike in a manufacturing floor where inventory piles up or machines sit idle, accounting waste is much harder to see. It shows up as duplicate reports, unnecessary reconciliations, extra approvals, rework, waiting time, excessive meetings, and inefficient handoffs between teams. You have to go looking for those inefficiencies because they rarely announce themselves. Especially when teams are siloed, there aren't good handoffs, and people rather rework somebody else's work because of mistakes rather than let those individuals know and give them a chance to improve. Once you start measuring, though, you usually discover far more opportunities than you expected. One of the concepts that surprised me during my Six Sigma training was that most organizations operate nowhere near true Six Sigma performance levels. Six Sigma quality corresponds to approximately 99.99966% defect-free performance, roughly 3.4 defects per million opportunities. And you might say, no company can achieve that. However, in practical terms, at a Six Sigma level performance, out of 10 million airplane flights, for instance, 34 flights would experience critical defects annually. At 99%, roughly 100,000 flights would crash, mishandle landings, or experience critical failure. Of course, I'm not equating accounting processes to flight safety. However, most business processes operate far below Six Sigma level. In fact, many organizations are closer to 2 to 3 Sigma in certain processes, which means that there is a tremendous opportunity for improvement. In accounting, that would mean that between 7% to 31% of all transactions contain waste, like errors, duplication, lack of automation, having overqualified staff, handle administrative tasks, unnecessary approvals, late work, rework, etc. The good news is that you do not need to find hundreds of improvements to make a meaningful impact. A handful of well-targeted improvements can create capacity, reduce frustration, improve quality, and generate significant financial savings. For me, that was another lesson. Accounting is full of processes, and wherever there is a process, there is an opportunity to improve it. In my departments, I held regular improvement opportunity competitions where my staff voted on all improvement submissions for the top 5 projects that we would focus on that year. They ranged from work-life balance, training, process improvement, system enhancements, and other improvements. People who do the work every day have fabulous ideas on how to improve the process. For me, the catalyst for learning and applying Six Sigma was the outsourcing effort that my company was undertaking. But to be fair, we probably should have started these process improvement efforts much earlier. Accounting departments are full of opportunities to eliminate waste, improve quality, create capacity, and improve work-life balance, if we're willing to measure the process and follow the data. If you enjoyed this video, please give it a thumbs up. And if you'd like to see more content like this, please consider subscribing to my channel. Thanks for watching, and I'll see you in the next video.